often people make a distinction between growth investors and value investors. And I would say that to us is a strange distinction, because a company that grows profitably is more valuable than one that doesn't grow. So growth is a component of value. What I would distinguish from is momentum investing. And maybe that's been a big characteristic of the market in the last 10 years. The idea that because something is going up, it's likely to continue going up. So I'm buying it without regard to the underlying value of the business, but with an idea that somehow this pattern will continue.
So today we have the Magnificent Seven, so-called. Do you regard stock purchases of those stocks as value investing or momentum investing?
Well, a little bit like when FANG was popular, or BRICS, and people come up with an acronym. They think the Magnificent Seven. But each one of those businesses has totally different business models, different prospects. They just happen to all be in favor at the moment. And I think the way to think about it is that when you get the valuations getting higher and higher and higher, you think about what would have to happen for you to earn a 10% return if you bought the whole business. And when you start breaking each one of those businesses down, what you find is there's some of them where they would have to grow, 20% a year for a decade. They'd have to maintain margins above 50%. And when you look at how many companies have done that in history, I think it's 0.1% of companies in the S&P 500 have kept margins above 50% for more than a decade.
But if what you say is true, most people who are buying stocks are not really value investors, right?
Well, I think that there's a whole category of people that get excited because stocks have already gone up, and then they want to jump in. So in a sense, they're what I would call momentum investors, but they aren't really value investors. Stocks have this peculiarity that they're the only asset where somehow the more the price goes up, the more people want to buy them.
Let's say like Nvidia, very highly valued stock company, or even Apple, which used to be very highly valued, still valuable, but not quite at the same multiple it once was. You would say those are not value investments, though Warren Buffett did buy Apple.
Yeah. Well, what I would say is that in order for Nvidia to be worth what it is, you have to extrapolate the durability of their competitive advantage way into the future. And if you think about the early days of the internet, we all knew who the winners were, right? It was Cisco, it was AOL, it was Yahoo. Those were the three titans of the internet. And in the early days of a transformative technology, people are very anxious to identify the winners. But remember, Google wasn't public yet. Amazon had, gone up to 80 and collapsed down to about 6. Meta, then Facebook, I don't think had come public yet. So there was a huge amount of speculation about who the winners of the internet were going to be before it was ready. Now, there's speculation today that Nvidia has won the AI game, that the future of AI will be driven by Nvidia in the same way the PC was driven by Intel, let's say. So it's possible that that could happen, but it needs to happen to justify the current valuation. You need growth for a decade to come. You need to sustain high margins. But I think that I think you have a lot of their customers who are going into their business trying to design their own chips. You have a fabricator, TSMC, Taiwan Semi, that in a sense the only company on earth that can make their chips. So Porter's forces would say that there's a lot of pressure on that going forward.
Your view on the economy now with tariffs as something that the president wants to impose, as inflation is still not completely under control, are you worried about a recession in the near term?
Well, I'm certain we're going to have a recession. I'm just not sure when. And that's a big part of our mindset is if we're buying a business that we're going to own for a decade, we know we're going to own it through some sort of shock in the system. What we sort of say is we can't predict, we can prepare. We have to be prepared, both for the sunny days where we'll make a lot of progress, but also to withstand the storms. And trying to predict the timing of those and reposition your portfolio, we think is a dangerous game.
So if somebody's watching this and says, I'm watching a famous value investor and I want to get some tips about what I should do, should you go try to look for stocks yourself? Should you give money to a money manager? Should you give it to a long-only money manager, a hedge fund money manager? And what kind of rate of return should the average person watching a show like this try to get for his or her money? Is it 6% a year to be happy with, 7%, 5%, 8%? What do you think a value investing person should feel they should get as a rate of return on a consistent basis so they can go away, take a trip around the world, and not have to worry about their money?
An investor should recognize that the biggest threat to their generating a return over time is their own behavior. And so if somebody has the mindset of when stocks go up, I get excited and want to get in, when they go down, I want to get out, that behavior penalty will swamp any other choices they make in terms of whether they picked great stocks, whether they hired a great manager, whether they invested in a great fund. So what I would say is, if you are prone to these very normal behavioral biases, having a great financial advisor who can provide that sort of courage, that fortitude, and that patience, like the two lions at the public library, patience and fortitude, an advisor who can modify your behavior is one of the most important investments you make. Now, if you're wired where you don't have that investor behavior problem, then that simple systematic investing, putting something away every month, every quarter, every year, those will matter so much more than whether you selected the hot manager or the right sector. You can get in at the wrong time, but if you stay in, you can earn your way out of that. What really matters is the behavior.
Why should somebody, a young professional, want to get into the value investing business? Is there a big future in that business? Is it more exciting than the other ones I've just mentioned? Why should some young professional want to be a value investor?
Well, they might be a masochist, but in a way, I think there's something, I would say the temperament of the young person is what's going to matter. In other words, do they have that patience? Are they thoughtful? This idea of being able to move in a very deliberate fashion, for me, it is incredibly suited to a research mindset. The other areas you mentioned, tech investing, it's exciting, it's dynamic, it's fast changing, and that suits a very different temperament. You think about the idea that being right more than you're wrong. Well, for a value investor, we think along those terms, but technically what really matters is not how often you're right and how often you're wrong. It's how much you make when you're right. So I don't mind that patience, that sort of sort of traditional mindset that says I'm willing to let the value of the business appear over time. I don't need it all at once. I don't need the big payoff.